For Germany, we know that a lot of our investments are in a way subsidized by the aggressivity of the financing. We can buy at a very low yield and still have a very nice cash return and still have a very nice IRR because the financing is extremely cheap. It's less the case when we come to, then France and Netherlands are more or less on the same level of financing. Spain is still very expensive. And the UK is a bit different because we always see alternative ways of financing which we don't find in the rest of Europe. So, but clearly for Germany, a lot of the competitions are going so high because of the quality of the financing.
When we're investing in the Netherlands, we're not using debt at all. When we're investing in, because our investors, the pension funds, they really, they have money enough, they don't need the debt. But sometimes, and that's the case in the international markets, we need the debt to make the yield level. So we want to keep the debt as restricted as possible. But investing in Germany, you need a debt of, I think, a leverage of 50%, something like that, to make it to the right yield level. Otherwise, you can't make it, and then you can't bid enough for the real estate which you want to add on your portfolio. So sometimes you need it. We don't like it, but sometimes you need it in the international markets.
What we do see in the debt market is that there's many more different lenders. The alternative lenders are actually they weren't there before. So there's much more sources where you can get debt. I think what you can say is there's a lot of competition, but it's in a certain part of the market. It is up until 65%, maybe stretched to 70%, and it's all, say, in the core end of the market. That's where the banks play, and they still have cheap financing from the ECB. So there you have incredibly low margins. Germany, the lowest, but also now, I think I just last heard that Spain now is at 200 bips, so that came from 750 not too long ago. So you can see in that part of the market, it's still very competitive. It becomes more difficult if you want to finance a value add or secondary portfolio, and then you probably can't get anything above 45, 50%. And you can still go over that, but then you have to go to the match lenders, which again you have to pay up for. So in that sense, the regulation have put kind of a ceiling on how much leverage you can put up, and also the private equity funds on an individual basis, they're willing to go to 80-90%, but overall in the fund they have to be probably below 60-50% to keep it attractive for their more conservative investors. So that is a summary of what we do see in the market. So there is a lot more, but we don't feel it's overheating the market yet.